Thank you for joining myself and Steve Black for the Pengana Emerging Companies Fund webinar. The format today will be a 20 to 25-minute presentation, and we will have times for Q&A. We would love to hear your questions. You can enter those at any time throughout the presentation in the Q&A box at the bottom of your screen, and we will endeavour to get to as many of those as possible at the end of the session. With that, over to you, Steve.
Mel, and appreciate everybody tuning in today. This is a presentation series that we conduct regularly, obviously every 6 months, but rarely do you hit a 20-year milestone. So we're proud, Ed and I, to have been running this fund for 20 years, and it's the same team, same process, same philosophies in terms of managing the fund. So just as a reminder, I know there's a lot of familiar listeners on this webinar, but just as a reminder that Ed and I are co-investors in the fund. So we were the two initial investors in the fund. We're also the two, obviously the two founders of the fund and the two portfolio managers of the fund. And Pengana Capital owns 50% of the business. So that's the structure of the vehicle we manage. And I think over the 30 years Ed and I have been managing and researching small caps, we truly do have a very strong focus on conservative investment management of the stocks that we pick for the fund. And that safe pair of hands is probably no better illustrated than you're looking at over 20 years, that when the market is down, 72% of the time this fund outperforms. And that's due through all the volatility of COVID, etc., which I'll have something to say about shortly. So that speaks volumes, I guess, as I said, with this type of company we look for the fund. So it's very much a risk-based approach to investing. We'll focus more on risk than even return, because when things go wrong in small cap investing, they go terribly wrong. So we'd much prefer to miss out than own stocks that fall 60, 70%. And about 70%, 70% of the fund is invested in the lower risk end of the spectrum, being companies that have long duration cash flows, predictable earning streams that aren't exposed to the vagaries of the economy. So the scorecard over the 20-year period, the funds deliver 12% per annum after fees. That's an excess return of 7% per annum. Something we're quite proud of is the fact that over that 20-year period, we've donated through rebates $2.6 million to Third Link, which is a Chris Cuff philanthropic organisation. So it's important for us to make a positive impact on the community as well. So what has the last 20 years proven? Well, I guess this is probably our playbook as to how we've gone about investing. We're certainly not timers of the market, so you can easily be wrong-footed just simply by the market direction and undo some very good stock picking efforts. So we will be fully invested at all points in the cycle. We are blessed with a very large choice of companies to choose from. So we have about 1,000 companies to pick a 60 stock portfolio from, and all that research is conducted by ourselves. So it's proprietary research. We don't have stockbrokers holding our hands. But you need to have a sensible level of funds under management to continue that level of outperformance. We avoid the noise, so we will not get carried away with charismatic CEOs coming through with IPOs or high-flying tech stocks that don't deliver a strong cash flow. We'll remove those from our field of view. And importantly, we have a very strong moral compass. So not only do we not obviously have the mining companies to worry about in terms of their carbon burning nature, but also in terms of socially, ethically place, we will not invest in, for instance, poker machine businesses like Light and Wonder as an example that jumps to mind. The key is management contacts. So we're turning stones over continually, trying to unearth the next opportunity for the fund. And our cadence since we started the fund was about one company meeting per day. And in an inefficient end of the market, there's no substitute for meeting companies regularly and, as I said, finding those mispriced securities that others aren't looking at. And it tends to be about 30 or 50% upside for that stock to qualify into the portfolio. And risk is very much stock specific. It's not a top-down factor-based portfolio risk measure, but with stock selection in small caps, it's all about understanding a company's risk, its balance sheet, liquidity in terms of the number of shares transacted, the quality of management. So that's where we spend a lot of our time and effort. And we make mistakes all the time. We're in the business of taking risk. We would expect to get 60%, hopefully 65% of our calls right. Sounds low, but that's the level of our performance that results from that strike rate. So it's more to do when you realise you've made an error as to how you deal with that error. And I'll talk to that shortly in the sense of our culture. Now, just a few thought pieces, and I won't labour the point, but as I said earlier, we don't invest in resource stocks. This is not the reason, but it's a fun chart nevertheless, just looking at the productivity enhancements of manufacturing and business services up against mining. It really is a difficult end of the market to drive efficiency for companies participating in it. So you are investing with one arm behind your back. This chart here is an interesting chart, just talks to companies that have been listed or how long they've been listed since IPO. There's probably a couple of takeouts here. Firstly, the longer a company has been listed, then generally the higher the returns. And that probably is partly explained by the exuberance, if you like, of IPOs that have a history of strong underperformance because they're overpriced generally in some of the more exciting industries. And also the compounders. The benefit of owning companies where you've got proven management over long periods of time with longevity and being able to model those earning streams with relative predictability is critical to how we build the portfolio. It's interesting that over the last 100 years in the US market, despite in effect owning the internet over there, the best performing industries have been tobacco, alcohol, food and chemicals. So the more mature boring industries are actually delivering some of the best outcomes. A large part of that will be not just the lack of enthusiasm towards them, but also in a marketplace that's not growing, you're obviously attracting less competition, and it drives greater consolidation and efficiency. So this chart here looks at the Pengana Emerging Companies Fund in blue and how its relative performance has tracked since inception of the fund. And then I've also stitched together the JB Weir Emerging Leaders Fund that I ran before setting up this fund with Ed. And it does obviously show you that active stock picking can work in the small cap space. If you can throw it at a GFC or a tech wreck or COVID or inflation, the process is all enduring. It does deliver strong outperformance, strong alpha if sensibly managed. So internal culture. So Ed and I are very well aware that in small cap investing, it's more about an art than a science. A lot of small cap managers that don't succeed for long periods of time, it comes about not necessarily through performance, just because they're lost their motivation or they're not as intact as a unit. So this is some of the measures we go to ensure that we continue to perform well. We certainly are interacting well. We have in place policies whereby there's no attribution of stock selection. We're truly aligned in every decision, how we value companies. We conduct meetings with management teams together. So it removes, and with the removal of distractions with Pengana up in Sydney, we're left to spend our day how we wish in terms of meeting these companies continually and, as I said, finding that mispriced security. So it's not personal. It never will be, never should be, because it's for the common good and longer term that we continue to get along well and continue to drive outperformance. And that might mean that there's a certain stock that one of us prefers over the other, but if we don't mutually agree on any stock, it just simply doesn't make it into the portfolio. So just reflecting now on the last 6 months, it was a strong period for us in terms of performance, and critically through the month of August, which is the reporting season month, we outperformed both the small ordinaries and the small industrials index by about 2%. There's always volatility now into the market, of course. You can see that some of the winners and the losers for us in the fund here, and the size of the fund is about $780 million. Average turnover of the fund tends to average about 40 to 50% per annum. And there's the table of the fund since inception. $100,000 invested in, or on the 1st of November 2004, will be worth just shy of $950,000 at the end of August. So obviously demonstrates the power of compounding, and particularly compounding of alpha. And this table here, this chart here, talks more to the top-down end of the market. Now, we're bottom-up stock pickers, so I'm sort of loath to talk too much about top-down influences, but it is very obvious to all that small industrial companies have underperformed large industrial companies over an extended period, as you can see on that chart on the bottom left there, and in particular the last 3 years. Now, I hazard to guess that the principal reasons for that are the indexing of fund. So as fund flows to index stocks, then by definition, their larger stocks will be the index, and arbitrarily they'll receive a greater influence in terms of driving up their share price as the money crowds around that end of the market. And also, obviously, in sort of dangerous times, geopolitical times, volatility, uncertainty, the money tends to gravitate to blue chip stocks. There's probably also an earnings reason for this, and I've spoken about, or I've quoted there on the top right-hand side. This is via Macquarie Stockbroking, where the small industrial companies have actually underperformed in an earnings sense against the larger industrial companies over the last couple of years. And that's not only because of the fact that they have more geographically diverse earning streams, particularly overseas, more so than the small industrials, but also they have in place larger treasury type functions that protect them against rising interest rates. So they can lock in fixed loans more so than the small industrial stocks, so it's protect them from some of the interest rate rises we've seen. Now, I think that is about to flip. We certainly think some of those headwinds will turn to tailwinds. That chart on the bottom right here is a chart or source from the US, only because they have a far greater number of recessions over there from which to prove this theory. But you can see there that coming out of recessions when large caps underperform small caps. So small caps start to get some of those tailwinds that I was just referring to. So the reporting season wrapped. We've spoken to approximately 60 companies over the last 5 or 6 weeks. And some of the messaging coming through is that margins have been very strong, probably surprising some analysts in the marketplace. So companies have had the pricing power to push through the cost increases to their customers. That potentially gets a little harder now into a softening economy next year. So we'd be quite wary of companies now that don't have that real strong pricing power. And in terms of sectors, tourism is certainly been impacted by a lack of inbound tourism. So we're still 15 to 20% below the levels of inbound tourism from pre-COVID. And in terms of the retail space, I don't think that's really been tested yet. Discretionary retailers have still been held up in terms of demand, because of consumers being fully employed. So I think into next year, if there is some signs of strain on the employment, then that will lead to discretionary spending falling. The weaker state is clearly Victoria, still struggling under the debt load of financing the COVID lockdown. And New Zealand, which is or has been in a recession, and potentially may go into a recession again, has been the weak spot that all companies are referring to. And then there's just a little bit of colour there on some of the better results in the reporting season, some of the worst results. Those are the share price moves in the month of August. And we don't own those companies apart from Charter Hall and a very small position, Audinate. But it just goes to highlight that some of these companies are household names in the small cap space and how they've performed in a very short period of time if they disappoint. And then the positioning of the portfolio, as I referenced earlier, so about 2/3 of the fund is invested in those defensive growth companies where management can actually make a difference. So as you would expect, we have a very large weight, or put a large weight on the quality of management. And that's only important if management can actually take control and influence a company's future prospects. Less likely in resources, for instance, where resource commodity prices or exploration successes will drive prospects of companies' earnings more so than what management can control. Similarly with some of the loss-making and tech stocks. And then over the last 6 months, it's a little bit detailed there in terms of new companies to the portfolio on the top left, companies that we've sold from the portfolio totally on the top right, and then the increases, those stocks we already owned but now like even more, have topped up, and reductions, but we still own those companies. Approximately half of those movements have come about through share price changes, either up or down, and then the other half is more stock specific. Our reassessment of the valuation. We value every company using DCF type methodology. So just breaking away now into a few stock stories, and it helps. I think it does help illustrate our process. Now, lifestyle communities, many of you would be aware. We've spoken about this ad nauseum over the last 5-6 years. It's a classic stock that we love to own. Recurring revenue streams, quality management, and that largely hasn't changed. What changed 18 months ago was simply that share price had got to a point where it was fast closing in on our valuations. So that triggered a part sale. And then a year ago, in meeting the company, we came to realise there was a new competitor on the block in terms of Stockland entering the market. This is the independent living village market or communities market in Victoria. And also debt levels had reached nearly all-time high. So there was back to the comment about risk. We overlaid our risk thinking in terms of our positioning in the fund, and that led to another reduction in our weight. And then in February, 6 months ago, they had an official downgrade. A lot of excuses. Communities weren't selling as they would have hoped, and they had to, with a lot of debt on the balance sheet to fund other community rollouts, they had to embark on a capital raising, which was very damaging to the share price. Now, we'd moved on from the company at that point. As I said, doesn't always work out like this, but it's a really good example of how we haven't fallen in love with the company despite it delivering incredible alpha for the unit holders of the fund. Still have a strong rapport with the same management team, but when things change, you obviously need to allow for them and adapt very quickly. Technology One is probably an example of a company that we had a smallest position in for a long period of time, only about 1% of the fund. And then things, despite share prices moving, things improved even more so. So they moved from largely a license-driven revenue stream to more of a SaaS recurring revenue stream. So more subscription-based type revenue, more predictable. And improve the business in terms of implementation time of their software, of their enterprise software to their SME customers from 120 days to 35. So less disruption for customers, less roadblocks, less reason not to take the software from Technology One. So all of that thrown into evaluation led to a top up of our position, which has obviously done quite well since we bought into it. And there graphically represents how this company's performed since it listed through the tech boom, a real survivor, great success story. And with largely the same management team, which is important. Now, Generation Development is a new position for the fund. You can see there we've only just recently bought into it. Probably best thought of as, and many of you listening to this call would be aware of this company. So half of the business, half the company's earnings come from Lonsec, which they now own 100% of, having taken out the balance they didn't own a few months back. And that allowed us, with a capital raising, to build up our position to a larger weight. And then the other half is in the investment bonds business. And these businesses, as you can see, the life bonds, Generation Life at the top there, the Lonsec Investment Solutions, which is the management consulting type business that they have, which pushes the SMAs to financial planners that are looking to outsource that function, and that money and how it's grown over time. These are very fast growing industries, as you'd be aware, and Generation Development is the leader in both these fields. So this stock trades on a P of about 25 times only. For us, that's highly attractive, given the growth on the table, and given the fact that once you've won this money over, you generally don't lose it. It's sticky revenue. And it does remind us a lot of what Netwealth and Hub24 were when we first bought into those in 2017. So back in 2017, Netwealth and Hub24 would have had approximately 3% of money on platform. Today, they have about 15%. and that's graphically represented there. And obviously the legacy platforms that haven't been able to reinvest in technology and improve their tech stack have lost share to particularly Netwealth and Hub24. Perversely, despite the share price moving as it has over that time, it still trades on about the same model we bought into these companies at a PE of about 40, 45 times. Again, doesn't scare us. We have far more confidence in these companies taking their market share from 15% collectively today to potentially 30% plus over the next 5 years, which is what we expect. And then just in closing, there's our top 10 stocks in the portfolio. And with that, Mel, I'll happily open the floor to questions. Thank you.
Thanks, Steve. That was a great update, and we have had quite a few questions come through, and they're all excellent questions, so I'll get through as many as I can. Firstly, and I think this does come up a little bit, Steve, have you and Ed formalized any succession plans?
Well, we did 20 years ago, and it hasn't changed. So the structure we have in place is such that should one of us leave, then a third of their holding of the fund, business of the fund, would be retained inside Pengana, so as to use that as currency to find another portfolio manager. So it's important to realise that that this fund, when we set it up 20 years ago, we had total autonomy to set this fund up, Ed and I, how we chose to. So we've got the reins. If we're wanting to stay in the industry, I think I can speak for Ed here. There certainly wouldn't be a reason to move to any other fund, because we've got this fund performing as we'd like, and we've got it to the size we want. And as I said, with the structure that we asked for and we set up at the start. So, but we're truly very passionate, and hopefully that comes through. And we love what we do. We keep it fun. We don't work 12 hours a day, so there's balance in our day. And remembering we don't contribute to other Pengana products. This is solely 100% of our focus. It's one product, and we don't have distractions of other funds, and nor the compliance type requirements, which are handled by Pengana. So, it's a question for obviously any capability where you are more reliant on the underlying fund managers, and as it is with small caps. So it's the right question, but I think the structure we've got in place, particularly with also joint with portfolio management responsibilities, that should one of us decide to leave, whether we wanted to or not, then the other one would be able to take the wheel, given we already have that, as I say, joint portfolio management responsibility until we found someone else.
No, and I definitely see that energy coming through whenever I have yourself or Ed up in Queensland. I couldn't imagine you not doing this. You've been performing over 400 company meetings for about 20 years. How quickly can you get a read on management now versus those early days?
Oh, that's a good question. So you'd be surprised that small company land in Australia is actually quite a small place. So we largely know who's who in the zoo, as it were, in terms of management teams that we admire and we like and trust. And so it's often a reason when a company or management team that we really believe in moves to another company, that would be a reason for us to pick up the phone and organise a meeting. But equally, I think what the question is really driving at is that there's certain styles of presentation that, in terms of how management teams will deal with questions that we ask, and those nuances we're certainly well aware of with individuals. So we kind of allow for that in terms of the type of answers we get to our questions, and also the style that Ed and I have in terms of questioning. We've got a certain approach to it where we can look to draw out the most information that we can to get the best, form the best view in terms of the potential of that company.
Excellent. Now, you did touch on reporting season in the presentation. Were there any results that you were really surprised by on the up or downside for companies you held or otherwise?
Well, there always is. Absolutely. Absolutely. There's always, that's why we own a 60 stock portfolio. So you'll have some winners and you'll have some losers. We'd like to think it's a period of time, being February and August, the two reporting seasons, where the average outcome is that we've delivered alpha for the month, because that tells us that our diversified approach has delivered a blended alpha for a period where share prices are moving based on real results, not sort of hype or sort of sort of beliefs of what a company should be trading on, volatility. It's based, the share prices are probably more appropriately priced in the months of February and August, because they're dealing with real facts. So it was encouraging for us through the month of August to deliver our performance of 2%, as I said earlier. But no, there's always a banana peel here and there, and you've got to react pretty quickly when that happens, which is, I'll turn you back to how we deal with stocks that disappoint, and we're in a position, we're not managing too much money, of course, that we're nimble enough to be able to reposition the fund quite quickly to deal with those situations in the fund.
And I guess the hype question, leading on from that, there's a few stock questions that have come through. So Life 360, Guzman and Gomez, did you perform any analysis on those pre or at IPO?
For sure, yeah. So they're not companies in our field of view, in the sense of satisfying the needs to get into the portfolio, principally on the back of valuation with GYG. I had a one-on-one meeting with that management team, and I was startled or staggered to believe that they could potentially take a market with that type of valuation and seek minority shareholders, but they did, and I was wrong, and it's up another 70% for now, anyway. But it is incredibly hyped. I think the market is starved of IPOs, so there was a little bit of scarcity in terms of the level of interest and demand for that particular company. But it's fair to say that in particular with that company, you need to extrapolate forward the current level of store rollout for 10 years. And by the way, no other company in that space, fast food space, has delivered that level of rollout for extended periods before. So they'd be setting new records there. But if they did that, then it justified the share price. Now that's just too much risk for us to bear. There's 1,000 companies to pick a 60 stock portfolio on. It'd be a big coincidence if that particular company that we met on that particular day happened to be the best idea on that day. I think that was a Warren Buffettism. But so with Life 360, that probably falls into the camp of a company which it's only just recently turned to profitability. And we're hardwired not to invest in companies that don't make money. There's too many moving parts. There's too many things that can go wrong till a company's actually commercialized, and delivering a return on invested capital will steer clear. That's what history has proven to us is the right thing to do. So as I say, they've only just turned profitable. They're on a P of about 100, if you want some context there. So, and we've met the company. We still think it's a land grab in that monitoring tracking space that is yet to be won. Then there's Apple and Microsoft. There's a lot of other Me Too type of technology coming out that potentially competes head to head with them, and yet investors are prepared to, I think, overlook that risk at the moment whilst they continue to deliver good subscriber growth. But I know it is over-owned and hyped, and people are excited with the share price and how it's moved. It's not. We don't have to swing the bat hard to deliver good alpha generation, because we have so much choice. We don't have to bear that risk. There's plenty of other companies we can find in the portfolio that don't have that risk, that deliver us strong upside.
And then another, I guess, in that similar space, Zip, you've recently added to the portfolio. You've had it there in the past, and it's been a really solid performer. But the number of other companies in that buy now, pay later space have struggled. What led you to reinvest in Zip, and what differentiates that company?
Yeah, and it's not really our cup of tea normally, that type of company, but it's a good example of where you've got to come at every company with a fresh set of eyes, and I think it clearly has been scarred by the past, but if you peel back the ASX code and look beneath, it's a totally different business. New management team, they've stripped back the business to now just being Australia and the US and removed all the distractions of other overseas opportunities. They've halved the corporate cost base. They've removed the debt that they had on the balance sheet. There was some quite predatory type terms to some of the debt they had on the balance sheet. So it's really a brand new company. So today, when we bought into it 6 months ago, I think the share price is up a lot since. But when we bought into it 6 months ago, we saw a company which was growing in the US at 45% per annum, which it has the last two periods, and 90% of its earnings come from the US. And the buy now, pay later space is in its infancy in the US. It hasn't anywhere near the penetration of Australia or Europe. So for that, we saw very strong upside. It gets a little harder from here, to fair to say, because the share price has risen a lot, but we'll still keep it as a small position in the fund. But buyer beware. We recognise it's consumer finance. Consumer finance is a very difficult companies operating in that space are very difficult to analyse because they're only as good as the book that they've lent out, and then need to recover that money. So you never really get a proper look through as to the various sort of risk parameters that they've tested their customers with before they issue credit to them. But as I said, we can allow for that with low risk.
Awesome. A couple more stock stories. We are dead on half an hour, so I'll ask maybe three more questions, and then please keep them coming as we will answer them later today. Have you looked at MGH?
We have, and we're due to meet up with them again soon. So MGH is it's probably a 50-60% of its earnings are in effect coming from property development, residential property development, which concerns us slightly with the cycle. But yeah, correct. It's a company, and I mean, particularly in the building material space, with the loss of Boral and CSR having and LA Brighton all having been taken over. There's very little representation of that in that space in the marketplace. So probably we'll get more attention going forward as well, as investors look to diversify across industry sectors. But no, we don't own it, but we're doing more work on it.
And MP1, it's fallen pretty heavily post-reporting season. Do you have a view on the stock at the current price?
So we own it in a very, very small way. A bit of a rounding error for the fund, fair to say. And the reason we had a very small position was because of the risk. And the risk that is simply they will operate in weird and wild markets overseas as a sort of network connecting business for data centers. And they've also had some new management team that's come in and trying to rev up the motor again in terms of the sales function and growth. And that's disappointed the market, which has led to the share price falling. So, as I say, it's small position for us. We're happy with the position at the moment because I think it's rebased with the share price having fallen, and it is offering a very critical service, but it's not without risk. So, as I said, we allow for that with the way.
And I don't think you touched on this in the presentation. You do generally, but when are you likely to underperform? So what conditions is the fund likely to underperform in?
Well, it depends on over the period of time. So myopically, we will generally underperform when markets will rise quickly. And that's because over those very short periods, because we own companies that are very defensive with strong earning streams, we can get left behind for a short while when the sort of the high-flying tech stocks, the Life 360s as an example, will tend to outperform those what they call high beta stocks, will tend to outperform. So we might get left behind for a little while when companies, when markets are rising very, very quickly over a day or a week. And the other time will be, of course, not owning resource stocks when mining stocks do very, very well. We did see that post COVID, not post-COVID, post GFC, where post GFC, because of China's capex, China's demands for our resources, capex was heightened. A lot of the mining companies did very well, and those share prices did well. Now, the stock selection will eventually prevail. That's what that chart showed you earlier, but there can be short periods of time where you can see levels of underperformance.
And I have a question for you. I think whenever I spend time with yourself or Ed, you're the right sort of balance. Obviously, I'm upbeat, energetic, but always a little bit skeptical. How do you maintain a calm demeanor, especially when markets are volatile, everything's falling to pieces? That seems to be where you're picking up bargains. How do you stay cool, calm, and collected during those periods?
Yeah, well, you're professionals. So Ed and I, having been in and around markets for 30 years, we expect volatility. I mean, in a perverse way, it's exciting and it can provide opportunities for us. That is, and particularly in small company land where there's always a lot of indiscriminate selling of companies simply because of the fact that markets are weak. There's usually money taken away from small caps, and particularly if you've got fund managers that have institutional money, for instance, which we don't, we're all retail, then institutional money and large banks of that money can be taken away from you. And then you need to scramble to try and sell down positions to satisfy that redemption. And that can result in, that disruption can result in some incredible buying opportunities, given we've got patient money and we don't see the outflows. We can invest with confidence knowing that even in a meltdown, that investors have schooled on long term, not short term. And so we've got that patient capital we can put to work and take advantages of other people's forced selling. So that's probably one example of why volatility is not a bad thing for us, and particularly the sharp downturns in the marketplace. But it's also keeping away from as I said earlier, the noise of markets. I mean, it's Ed and I. We're not in a large room with hundreds of other people crying and shouting and getting excited over with the animal spirits with markets movements. We're pretty clinical in how we do it, and we know what works, and have, as I said, been doing it for close to 30 years now. We'll just stay disciplined.
I think a very safe pair of hands. We might wrap up there. If there are any questions that we didn't get to, we will answer you directly later today. Thank you so much to all of our attendees for dialing in and hearing from Steve. Thank you, Steve. I think it was a great update. We also have another webinar on tomorrow. So Amy Pham, who runs our High Conviction Property Securities Fund, same time tomorrow, and she's going to get a bit of an overview of her strategy and how she sort of finds active opportunities in that space. But thanks again. Thanks, Steve, and enjoy the rest of your day.